Dear participants, today we are starting legal principles in insurance. This is chapter number 5, which is a part of the curriculum of CFP program. When we talk about legal principles in insurance, there are certain principles in insurance which are different from other commercial contracts. Commercial contracts, basically, they are based on a caveat emptor. This is a Latin word. Caveat emptor means let the buyer appear. That means the buyer, the person or the company or the organization which is purchasing the products, which is buying the products, have to be cautious about the anecdotes, about the financial solvency, the financial viability of the person, about the quality of the product, about the quality of the services which they are purchasing. For example, we come across commercial contracts. We come across contracts wherein contractor commits his proposal to a company that, for example, he wants to build the road for a government organization. So government organization is the buyer of the services of this contractor. So that organization has all the rights to ask for the proofs of the past work done, whether they are registered with company, proof about their equipment, the material, their manpower, their technology, their skills, etc. Many times the organization which is hiring the service of a particular contractor also has the right to ask for their past successful executions, similar executions, other certificates of appreciations, and they may also inspect their premises, whether they are capable of delivering the goods or services or not. They can also include certain clauses. So that means the buyer has to be prepared. Everything has to be in writing. For example, the delivery conditions, the delivery time, and in case of any default on the part of the contractor or the supplier, many times there is a clause in the government departments that they also put a penalty for late supply. According to law, they cannot go to the court of law. The buyer cannot go to the court of law citing that I have bought these things in trust. We are buying so many goods and services out of trust, but at least we want to sue a particular person. We have to show the bills, the vouchers, the guarantee card. Therefore, the buyer has to ask for nothing can be taken on trust. Whereas on the other hand, in insurance contract, the major difference between legal contracts and the insurance contracts is insurance contracts are not based on caveat emptor. Rather, they are based on another Latin sentence of that is overe imam fides. It means utmost good faith. Now, the most obvious question which arises is that why we are dealing with utmost good faith? We are asking for proofs in insurance also. Insurance companies do ask for medical proofs, other age proofs, etc. So why we are saying that insurance contracts are based on utmost good faith? Basically, if we talk about life insurance contract, let's talk one by one. Let's talk about life insurance. Life insurance basically is a contract where the risk cover of death of an individual is covered. In case an individual dies within the term of the policy, a particular sum assured is given to the life assured. So therefore, while granting the insurance company has to ensure that the person is enjoying the best of his health. He is having a normal health. He is not carrying any critical disease with him, or he doesn't have any habits. He's not an alcoholic. He's not a drug addict. He doesn't have any deadly disease. So how to ensure this? Unless and until the person himself or herself declares that yes, he had undergone a particular operation, or he's suffering from a particular disease, let's say thyroid, let's say asthma, let's say blood pressure. On those basis only, the insurance company will try to interpret that how a particular illness, it may be a small illness, but how it will develop in the years to come. So they will interpret it, say in the next 20 years, next 25 years. So therefore it is the duty of the insured himself or herself to declare what type of illness he has or he doesn't have, what kind of family history he has, what kind of past illness history he had, whether he was operated upon, what kind of occupation he is engaged in. Many times there may be some adverse habits, even the close family members may not know that the son indulging in some hazardous activities or close relatives and neighbors apart, even the family members doesn't know. So only the person can declare about himself or herself. So therefore a matter of trust comes in, a matter of utmost good faith comes in. So proposal form which the person signs while applying for an insurance policy. So proposal form acts as an application for insurance, and when he signs in the declaration after giving answers to all the queries, that declaration itself, it becomes the utmost good faith part becomes operational by signing the declaration in the proposal form. So therefore, although age group is asked for, medical tests are conducted in some cases, but they are not the ultimate test. They happen that a person is suffering from diabetes, and on that particular day, the diabetes may not come. Many times we know that people suffering from diabetes, the sugar levels also go down after taking medications. A person may be suffering from a heart disease, a heart attack disease, but on that particular day, his ECG may be quite normal. Just to rely on medical tests on a one particular day would not be justified in coming to a conclusion that a person is okay. So therefore, again, one has to rely on the statements given by the insurer. Similarly, let's take another example of general insurance. Here also, the insured is expected to clear that yes, suppose a person wants to insure his vehicle, and in case the vehicle have already been stolen some 2 or 3 days back, and he didn't lodge the report to the police station, rather he wants to now insure the vehicle, and after that he wants to lodge the report of his theft, because insurance company also sends its personnel to verify the assets physically. But then again, it also is the duty of the insured person. So by including this clause at a later stages also, if insurance companies come to know that a certain fact was wrongly mentioned, or the facts were distorted, or there were some manipulations in the proposal forms, so the claim amount can be withheld, the claim can be repudiated. And what to talk about claims, the contract, even if there are no claims, if such kind of false statements come to light, the contract may be made null and void. So therefore, the importance of utmost. So it is said that, so what facts the insured person or the proposer is supposed to reveal? Well, the insured is, you would say that he should reveal whether he was having a headache last night, or he was suffering from fever last month. So should he reveal all these smaller facts also? So what facts he should reveal, what facts he should not reveal? So therefore, insurance contract says that he should reveal all the material facts, or the facts which are material in nature. Now what are material facts? Material facts are those facts which may influence the judgment of a prudent insurer in deciding whether to grant an insurance or not. And if to grant an insurance, on what terms he can grant the insurance. First of all, they will decide whether to accept or whether to reject. If to accept, whether to accept at original terms and condition or to accept at modified terms and condition. They can reduce the term, they can reduce the sum assured, they can delete 1 or 2 riders, they may change from one plan to another plan. They may say, no, we can't give you whole life insurance policy, we can give you only endowment policy, or we can give you only insurance for next 15 years, not for 25 years, which you have applied. So therefore, material facts are those facts which may influence the judgment of the prudent underwriter or the prudent insurer to decide, to take a judgment whether these facts are crucial in estimating the amount of risk. Headache, cold, all these fever, they will not influence the risk which is being covered. The risk of death is covered. So that everybody knows, this is a common fact, that these are common illnesses which everybody has to cover. These are not such illnesses which influence the risk cover. There are certain other diseases like heart attack, like very high blood pressure, then also what is the degree of that blood pressure? Whether it is within the range. If it exceeds the maximum or the minimum range, then also they have to. They will not refuse it, but they may charge an extra payment. So similarly with general insurance also. In engineering risk, fire risk, what kind of safety equipments they have installed. So all these factors, all these are material facts, which may increase the risk or which may also reduce the risk, so that they may decide. So utmost good faith is the first basic principle which is important in insurance. The second basic principle is the principle of insurable interest, which is a very important principle in insurance. In Hindi we call it Bima Hit, and utmost good faith is called Param Sadbhava. So insurable interest, what is an insurable interest? A person is said to have an insurable interest in that object, person or a thing, the destruction of which or the loss of which may cause him a financial loss. or may put him in a position where he has to bear the pecuniary loss of that. Pecuniary means economic loss or financial loss. For example, I may be very close to this gentleman. I'm very close to you. If God forbids, if your vehicle is stolen, I will also feel bad. This will be a loss to me because I will feel bad that since you were very close to me, this happened to you. Your vehicle got stolen. But will I have to bear the financial consequences of that? No. Only you will have to bear the financial consequences of that. So, because you are the owner of that vehicle. So, if you are the owner of the vehicle, being the owner of the vehicle, you have to bear the financial consequences of any damage or any loss to your property or to your asset. So, therefore, you have an insurable interest property in that product, in that object. So, therefore, you will be the insured person. Not I. I cannot insure your motorcycle. Similarly, we have our monuments in India. We have Taj Mahal, which has become one of the 7 wonders of the world just today. And if suppose anybody wants to insure the Taj Mahal because it's a cultural heritage of our nation, but then insurance company will ask him, you may be having a lot of interest, you may be having emotional interest, sentimental interest, national pride, but you don't have a financial interest in it. If something happens, some loss happens, the government has to bear it. The Archaeological Survey of India has to bear that loss. So you don't have the insurable interest, the Archaeological Survey of India has the interest. Similarly, in the case of life insurance, now the question arises, who has an insurable interest on whom? The same definition applies to life insurance also. A person is said to have an insurable interest in the life of another person, the loss of which may cause financial loss to the first person. A person himself or herself has an insurable interest on his or her own life. It is a universal fact. Because everybody's life is dear to each and every person's. One's own life is dear to every person. So it is said, and it is a universal insurance fact, that a person has got unlimited insurable interest in his or her own life. One cannot specify a particular amount for one's own life. A normal person won't. So, similarly, there are several relations in which insurance world over have come to a conclusion that these persons have got insurable interest in the life of another person. Husband is said to have an insurable interest in the life of his wife. Similarly, wife is said to have an insurable interest in the life of her husband. In the Indian context, wife is said to have an insurable interest in the life of the husband because husband is bound to support her. Husband being the breadwinner of the family, so therefore definitely the wife has an insurable interest in the life of the husband. Husband also has an insurable interest in the life of his wife, whether she is earning or she is not earning. If she is earning, then definitely there is a loss of income. Even if she is not earning, she is a housemaker, she is a homemaker, then also Indian courts have ruled that since she is contributing to the welfare of the family, in raising the children, in the management of the house, so that also can be quoted with money. Had such housewife, then this work would have to be outsourced from outside, so which costs money. So therefore, both has an insurable interest in the life of each other. Similarly, a creditor has an insurable interest in the life of debtor, to whom he has lent the money. The creditor may be an individual, the creditor may be an institution like a bank or a financial institution. But not vice versa. Debtor doesn't have insurable interest on the life of the creditor, because the debtor has nothing to lose. Rather, we would say in a lighter vein that debtor has to gain if the creditor is no more. Similarly, employer can also have an insurable interest in the life of the employee, subject to the extent of the services provided. We have key ban insurance in insurance, life insurance, wherein an employer can take a life insurance policy on a key person of his organization. Similarly, an employee can also have an insurable interest on the life of the employer, subject to the extent of his remuneration pending with the employer. Now, the relationship like brothers, sisters, uncles, there is no definition of insurable interest in any of the insurance acts worldwide. Firstly, we can say there is no insurable interest defined. It depends on the circumstances to define the insurable interest. Yeah, Parents do have insurable interest on the life of their children, but not when they are small. They will have insurable interest once they would be earning. Since the children are small, there is no loss of income. But then, because they would earn in the future and they will take care of their parents, so just to give insurance to the children, it's not the case of insurable interest. It's not because of insurable interest, but it is because of several other factors that insurance is proposed by the parents on their minor children. So insurable interest is not directly defined in the case of minor children. We come to third most important principle, which is principle of indemnity. It will be interesting to note that both these principles, utmost good faith as well as principle of insurable interest, they apply to both life insurance as well as non-life insurance. Whereas principle of indemnity only applies to non-life insurance, which is also known as general insurance. What is this principle of indemnity? Indemnification. Indemnification or principle of indemnity means that the duty of the insurer is to place the insured in the same financial position as he or she was before the happening of the loss. For example, just to make it simple, for example, a vehicle has been damaged due to a collision, due to an accident. So, after the damage, the estimated claim amount was, let's say, rupees 20,000. So the insurer would give the insured person equivalent to 20,000. The insured person should not be in a position to take, say, 40,000 from the insurer. What will happen in this case? If he manages to take 40,000, whereas his actual loss is what 20,000, he would make a profit of 20,000 rupees. So that means next time the insured would like the loss to happen, he would, or he may himself cause the loss, because it is a very good business proposition for him, because he is making this much loss. So next time he would like to make a loss of 40,000, actual loss of 40,000, so that he can again make, instead of 20,000 profit, he would like to make 40,000 profit. So therefore, the duty of the insurer is that the insured should not be in a position to make a profit out of his loss. Rather, they deduct the depreciation, because that is the usage value of the asset which he has been using for, say, 2 years or 3 years. So accordingly, the depreciation is also deducted. There are certain other deductibles in general insurance which are known as access amount and franchise amount. The first loss he has to bear, so that he is also vigilant always to reduce the losses. So principle of indemnity is why it is not applicable in life insurance, because there is no value associated to the human life. Although we will study in our later chapters that there is a human life value, but that human life value is just calculated to avoid hazard, which is known as a moral hazard, so that a person does not over-insure himself or herself. So that is another thing. But there is no value associated to the human life, so we cannot say that yes. In the case of non-life assets, suppose the asset's value is 4 lakh, so it doesn't mean if a loss has taken place, the company will give 4 lakh. They will give only that compensation which is equivalent to the amount of damages. If suppose the amount of damages is just 50k, so they will give only 50k. Less depreciation or deductibles, whatever is applicable. Whereas in the case of life, if the uninsured is 4 lakh, then and on the death of a person, full 4 lakh would be. There is no question of any deductibles or the value or the market price of that product. No. So therefore, these are the 3 main principles. I would like to invite questions from the participants.
As for the principle of indemnity, when we are asking that the non-life is just applicable to non-life insurance, and if we take this principle onto life insurance, if a candidate is having a kind proposal is having an income of 10,000, and can he just go in for a 5 years insurance for a 1 crore or something? And this can be possible in that.
Yes, this is what I was referring to just now. The principle of indemnity does not apply, but it's another principle which applies in life insurance. For example, a person who is earning, let's say 12,000 rupees per annum. Let's say 1,000 rupees per month. Now this person wants an insurance of 10 lakh rupees. Some insurance. A 10 lakh rupees insurance may be a very small amount of insurance for a person who is earning, say, 10 lakh rupees per annum. But for a person who is earning just 12,000 per annum, a 10 lakh amount is large amount. But you would say, since there is no value associated with a human life, and human life is invaluable, So why an insurance company, it's not the prerogative of insurance company to decide that this man is not worth 10 lakh rupees, invaluable to his family members. But then there are a few hazards which will discuss: physical hazards, occupational hazards, moral hazards, and moral hazards. So moral hazard, in Hindi we call it नैतिक जोखिम, नैतिकता के आधार पर. Moral hazard, it may happen. We are not casting aspersion on any particular person, but because insurance has to be given on large basis, on country-wide basis, and now on international basis, companies are operating on global basis. So therefore, we can't know a person who is earning a very paltry amount. He may be contemplating suicide for himself. He may take a very high sum assured on himself, and so he wants to leave some part of estate to his family because he is disillusioned with his life. So that is one kind of moral hazard. Second kind of moral hazard could be the family members could also become the enemy of this person. This person would, in his lifetime, not be able to even show 1 lakh of rupees to his family, and he has 10 lakh on his head. So a family member can also become an enemy of this person, or the relatives of the close blood relations can poison their minds. So that another moral hazard can take place. So, or another person can murder this person. This person may have risk on his life because they know that he is having this much of insurance. So therefore, it becomes non-relevant, for this person. So he has to prove that why he wants such a high insurance. What is the need? So the basic thing for the underwriting is the department in an insurance company which assesses the risk. So they first of all want to answer the basic question: why this person wants an insurance? There was a case wherein a student had applied for an insurance of 15-20 lakh. He belonged to a very rich family. But he said, the agent said he is from a very top industrialist family, he is from a very rich family, but the insurance company refused. He said, what is the need? He is just studying, and what is the need of such a high insurance at this stage? He could wait for some time. So that time even the family background also didn't work in that. So that is why this moral hazard is different thing. So that the company should also not make a law, because company has to be answerable to all its policy holders. It's not a question of profit and loss. Company is basically trustee of the pooling of funds. The money is of the public. So therefore they can't do this adverse selection of people like that.
Suppose I'm going to have an insurance product. What are the material facts I have to disclose in my... Will it be specified in the application form which I will be taking from you?
Yes, there are a few questions in the proposal form, is a kind of an application form. For example, if you are taking a life insurance, then you have to answer various questions from which an insurance company will assess the various hazards. Number one, physical hazards. Physical hazards means your age. For that you will have to submit your proof also, because age is very important. Age is very material to risk of life, because it's a common fact that as age increases, the risk on us is increasing. The mortality rate is increasing. Age, then your build, your overweight, your weight exceeds a certain limit or you are underweight, so you carry different types of risk. Then your past medical history, your present medical condition. Your family history also plays an important role. If in your family you have your grandparents who are living and you are in their 80s or 90s, then it gives them a positive signal. Then you will get credit points for that. On the other hand, if a person shows that one of his parents died in early ages, say 40s or 50s, and due to natural causes like heart attack or something, then it gives them a body wealth. So all these factors, all these cumulative factors, they help them in deciding the rating factor for this particular person. Similarly, for a non-life risk also, for a building, if it's a A-class construction, if it's a B-class construction, whether it's RCC construction, whether it is RBC construction, concrete construction, all those things, whether fire safety systems have been installed properly or not, fire alarm systems are there or not, breathing apparatus or not in industries. So all these are material facts. What kind of risk, what kind of boiler is installed, so whether it's a coal-fired boiler, whether it's an oil-fired boiler, what kind of fuels are used, so what kind of risk can occur. So all these are material facts. So one should not give wrong facts in those aspects. Insurance company may impose excess premium, but that's fine. since insurance, we have given the correct fact, insurance companies have charged you extra premium, but the person is safe. They cannot make the contract null and void at a later date if some facts have been withheld, have been concealed.
So while taking up the new term policy, can I nominate any of my friends? Is it necessary to nominate any blood relation person, or can I nominate my friend as well?
Okay, this is a very interesting question and a very tricky, controversial question. It has been in the insurance circles. Basically, different insurance companies have got different rulings. But first of all, we will see what does Insurance Act 1938 says. Insurance Act 1938 says that this is the right of a person to make anybody as a nominee. A person can make his friend also as a nominee. This is the right of a person who is being insured in the case of life insurance. Whereas, as per the precedents which the insurance companies in India have been adopting, including Life Insurance Corporation, and prior to that also, when privatization used to be there before 1956. So, insurance companies in India have been harping on the fact that the insured person can only make nominee out of his blood relations. They can be wife or children or parents or brothers or sisters or maybe nephews and nieces, but not other than that. Friend, they don't accept friend, they don't accept say a lover as a nominee for that matter, because they don't have, because they foresee that there might be a moral hazard in the future time to come. Nominee other than a family member may know that this person is having insurance on himself or herself and may concoct something, may manipulate something. So because of that, because of some moral hazard, because of the judgment, they want to treat very cautious steps. So therefore, and then they are answerable to their policyholders, they are answerable to their shareholders, they are answerable to the regulating authority, they have to maintain their solvency. So therefore, the general perception, and we can say now the general rule is that only the blood relations can be the nominee. Otherwise, the Insurance Act has not specified that only the blood relations have to be the nominee. Thank you.